November 2022. Thousands of investors are trying to withdraw their money from FTX. This isn't panic without reason. Someone just published the real numbers, and the numbers didn't make sense. Within hours, something impossible becomes clear. One of the largest cryptocurrency exchanges in the world doesn't have its customers' money. This isn't a market crash, not volatility, not the price of Bitcoin. It's that the money was never there. In 72 hours, an empire valued at $32 billion vanishes. How does someone build something like this, and how did no one see it coming? The origin. To understand FTX, you first have to understand its founder. Sam Bankman-Fried, 29 years old. Mid-economist, disheveled hair, shorts and a t-shirt in meetings with senators. The image of the genius too busy for formalities. In 2017, Bankman-Fried was working at Jane Street Capital, one of the most sophisticated trading firms in the world, and he discovered something. Bitcoin was priced differently across markets. In Japan, the price was up to 30% higher than in the United States. If you bought here and sold there, you made money with almost no real risk. That's called arbitrage. That's how Alameda Research was born. A quantitative crypto trading firm, designed to exploit market inefficiencies, fast, technical, and opaque from the start. But Bankman-Fried wanted more. To run arbitrage, he needed exchanges to trade on. And the existing ones were slow, expensive, or unreliable. So in 2019 he built his own. FTX, founded in the Bahamas. Minimal regulation, maximum growth, the ascent. FTX grew at a speed the financial industry rarely sees. In 2 years it went from startup to one of the 3 largest crypto exchanges in the world. The valuation reached $32 billion. Sequoia Capital invested, SoftBank invested, Tiger Global invested, funds that had backed Google, Facebook, and Alibaba bet on a crypto exchange founded 3 years earlier. The celebrities arrived: Tom Brady, Gisele Bündchen, Stephen Curry. Their names and faces sold trust. Trust sold accounts. Accounts sold money. FTX sponsored the Miami Heat Arena Super Bowl commercials. A presence in the U.S. Congress, where Bankman-Fried presented himself as the responsible face of crypto regulation. The shorts-wearing kid in the Capitol. The disheveled genius who would bring order to the chaos. But there was something no one was seeing, or that no one wanted to see. The illusion. FTX and Alameda Research were, in theory, 2 separate entities. FTX, the exchange. The platform for customers. Alameda, the trading fund. Bankman-Fried's company. In theory, customer funds held at FTX were safely custodied, segregated, protected, available at any time. In practice, they weren't. FTX was lending customer money to Alameda Research. Alameda used it to make trades, to invest in other crypto companies, to pay debts, to fund its executives' lifestyle. And the collateral backing many of those loans was FTX's own token, an asset that FTX itself created, whose value depended on confidence in FTX. The same structural error as always. Using your own paper as collateral for your own debt. If confidence in FTX held, the system worked. If confidence in FTX fell, the collateral lost value. Alameda couldn't return the money, and FTX customers discovered their funds were gone. A structure that only survived as long as no one asked the right questions. The trigger. On November 2, 2022, CoinDesk published an article. Alameda Research's internal balance sheet had been leaked. What it revealed was disturbing. A massive portion of Alameda's assets were not dollars, not Bitcoin, not Ethereum. They were FTX, the token X itself issued, the same coin that backed the loans, keeping the entire system alive. 4 days later, Changpeng Zhao posted a tweet. Changpeng Zhao, known as Is, was the founder and CEO of Binance, the largest crypto exchange in the world, and one of FTX's earliest investors. Until that moment, the tweet announced that Binance would liquidate its entire FTX position. No drama, no accusations, just a risk management decision. But the market read the message correctly. If the world's largest exchange was getting out of FTX, something was very wrong at FTX. In less than 72 hours, customers tried to withdraw $6 billion. The money wasn't there. The implosion, on November 8, 2022, FTX suspended all withdrawals. Bankman-Fried attempted one last move. He negotiated a rescue deal with Binance. He publicly announced he would consider the acquisition. For 24 hours, it seemed there might be solution. Then Binance reviewed FTX's books and walked away. The hole was too large. Customer funds had been used in ways that made recovery impossible. On November 11, 2022, FTX filed for bankruptcy. Bankman-Fried resigned as CEO. The man appointed to manage the collapse was John Ray, the same attorney who had handled the Enron bankruptcy. His assessment was direct. In 40 years of practice, he had never seen such a complete failure of corporate controls. Approximately $8 billion in customer funds gone. The system. On December 12, 2022, Sam Bankman-Fried was arrested in the Bahamas, extradited to the United States, charged with securities fraud, wire fraud, money laundering, and conspiracy. In November 2023, he was found guilty on all 7 counts. In March 2024, he was sentenced to 25 years in prison. But the question that remains is not about Sam Bankman-Fried, it's about everyone else. Sequoia Capital published a glowing profile of him, describing his ability to multitask during a due diligence meeting. Institutional funds with decades of experience, invested without independent audits. Regulators across multiple jurisdictions, looked without seeing. Why? Because context matters. Because in 2021 the crypto market was worth $3 trillion and everyone wanted a piece. Because FTX arrived with MIT credentials, effective altruism rhetoric, and the promise of being the responsible adult in the room. And because when money seems easy, the hard questions disappear. The collapse of FTX was not just the failure of one company, it was the failure of an entire ecosystem of incentives that rewarded growth over solvency, narrative over numbers, and blind trust over real verification. The mechanism was new. The pattern was not. An exchange that used customer funds as if they were its own collateral that depended on its own credibility. A network of investors and celebrities who confused access with due diligence. And a system that only worked as long as no one looked too closely. $32 billion. 72 hours. And the money wasn't there. It never was.